There are dramatic changes coming for student loans, including big differences in how you can settle your debt and how long you may be on the hook for paying. So, up until now, there were a bunch of different repayment options students could choose from based on income or other situations. But a provision from President Trump's Big Beautiful Bill Act, which he signed last year, just went into effect, removing most of those options and leaving only two main choices for borrowers. The first, the repayment assistance plan, will now be based on adjusted gross income, changing the way payments are calculated. The second is the tiered standard plan, with payments based on the borrower's outstanding loan balance as a set fixed term from 10 to 25 years. Experts say the effects on borrowers will vary. Some might not see much of a difference in what they owe each month, while many lower income borrowers will be hit the hardest with increases. Namely, Trump's overhaul ends the most affordable option for financially strapped borrowers, the SAVE plan, which launched under President Joe Biden. Some borrowers under SAVE may not have needed to make any payments yet and may have had their loans forgiven in as little as 10 years. But under the new plan, borrowers at the lowest income levels must still pay at least $10 a month and will have to make payments for 30 years before they may be eligible for loan cancellation. The changes under the new payment options will force many of the more than 7 million people enrolled in SAVE to pay more in their monthly federal student loan bills. And millions enrolled in Biden administration plans will face sharp payment spikes because they have not had to make any loan payments since July 2024, while their loans have been in forbearance during a Republican-led litigation process. Now, with the SAVE plan ending, not only will the payments start again, but borrowers' debt balances will also have incurred interest since summer 2025. Now, there are some aspects of student loans that Congress has created that are sticking around, like the legacy income-based repayment plan geared towards those with a high debt relative to their income. But overall, this move has left borrowers with a lot less flexibility. Almost 43 million student borrowers carried nearly $1.1 trillion in loans, according to the federal student aid statistics for the first quarter of 2026. The new direction is part of the Trump administration's broader goal of slashing funding from government assistance programs across federal agencies. Student advocacy groups and financial planners worry that these changes will only make it harder on people already struggling with inflation, rising housing, food, and healthcare costs. They warn it may drive some low-income and first-generation students towards the private loan market, where costs can soar even higher and operate with fewer protections. They also fear the changing loan costs may turn those students away from higher education altogether.